Welcome back to Switzer on Australia's Business Channel. Last time they were on the show, the Montgomery Fund saw little value in the market. So has their view changed, and what stocks do they like now? We're joined by the company's CEO, David Buckland. David, welcome to the studio.
Thank you, Matty.
So firstly, you guys are regulars on the program, but for those viewers that don't know, can you talk us through your investment methodology?
Sure. What we do, Marty, is we look at every stock on the Australian Stock Exchange. There's about 1,850 and we rank them from an A1 down to a C5. So it's like a 15-cell matrix. And that's based on things like creditworthiness, free cash flow, return on equity, quality of balance sheet, etc., etc. And we'll only invest in an A1 down to a B3. So 6 of the 15 cells, and the other 9 cells we just won't invest in because they're below investment grade. So what we're looking for, Marty, is high quality businesses, high return on equity, increasing return on incremental equity, and very good balance sheets.
Okay. So you use, I guess, an intrinsic value methodology?
Correct. And then the most important thing is, obviously, on one dimension you want quality, on another dimension you want prospects, good prospects, and then the third dimension is price. And there's no point in paying a ridiculous price for a high quality business with good prospects.
Yep.
We've actually got to buy them well. That's the crucial missing piece of the jigsaw puzzle.
Yep. So those factors you mentioned there then, are they the determining factors in working out a company's intrinsic value?
Well, a company's intrinsic value is based on the company's earnings
Yep.
and the earnings ability over the medium term. So things like the return on incremental equity. So as a business expands,
Yep.
it spends money, and you're trying to work out what sort of return it gets on that additional spend. Now, businesses with low return on equity, for example, often get a very, very poor return on incremental equity. I mean, for example, take the airline industry. You know, it's an abominable place to invest. So for us, it's just not investment grade.
Yeah. So what's your thoughts on the markets right now? Last time you were on the show, we mentioned it in the intro, you and it was either you or Roger, and I know the interview was with Peter, weren't too positive or couldn't see much value in the market.
Yeah.
Have your views changed?
I don't think we can see a huge amount of value. I think what's happening is selectively there's few things coming up. But look, let's get some context here.
Yep.
18 months ago, June 2012, the market was about 4,100 points. Today it's about 5,300 points. It's gone up about 1,200 points or 29% in 18 and a half months. That excludes dividend returned, of course. So it's had a really good run over the last 18 months. But one of the reasons for that run are that world interest rates in the Western world are at record lows. So people, my parents' generation and even our generation, Marty, are going, I'm earning nothing in the bank. I've got to make my money work a bit harder, particularly on an ex-inflation, ex-tax basis. So it's forcing us to invest to some degree. Things are going up, and then there's a bit of a wealth effect that's going on. So that's point one. Point two is if you look at the US market, it's obviously had a tremendous run from its March 2009 lows. It's nearly tripled, okay? But what happens is if you step back a bit and look at some very, very long-term valuations, such as the Schiller cyclically adjusted PE ratio, which looks at the PE of the market based on the average of the last 10 years' earnings. That ratio at the moment, that it's called CAPE, or the cyclically adjusted PE, is on 25.5 times. And the long-term average of that average has been going for 120 years. That long-term average is normally on about 15 or 16 times. So it's selling at about 50% above
Suggesting it's
long-term
overpriced.
average. There's another ratio called the Tobin-Q ratio that again is 120 years old, and that's the price relative to the replacement value of assets. And again, over that 120 years, it's still very, very high. So you've got these two very, very long indicators are saying to you the markets are at the expensive end of the spectrum. But I actually believe it's because the central banks have got interest rates at next to nothing or close to it. It's forcing us to do something with our money.
So on the back of all that, what do you like right now?
So the back of all that, you've got to be very, very selective. So, for example, there were several floats late last year, but there were a few that we thought were pretty special. One was the Vader Group, which was $1.25 was the float price, and if you're lucky enough to get any, you did very well. They came on straight away to 40% premium, and they've since traded up from $1.75 to sort of $1.85.
Yep.
So that's done very well.
They specialise in bankruptcy searches, debt collection, that sort of stuff.
It's like a credit reference association. aviation business.
Yeah.
And, they obviously, I think they get something like 86% of their business from the major banking sector. So as the banks check us out every time we want to make a transaction or get a loan, these are the go-to guys. So Vada's been a good one. I think there's another very, very small business, but it's called Life Healthcare. LHC is the code. It's only a very small business, capitalised at about $85 million, but in the health industry.
It IPO'd last year, did it?
It IPO'd also very late last year. I think it was early December. And, it's a stock it's selling on about 11 times earnings, fully franked dividend yield of about 6.5%, good prospects and good tailwinds. So I think what happens is you can selectively pick the eyes out of the market, but I think in general terms it's hard to find incredible value.
So do you like anything in the 200 at the moment?
I think what we've done at Montgomery is we're just, picking little things that come back. So, for example, Macmillan Shakespeare was one that came back during the sort of the K-Rudd episode of trying to change the fringe benefits tax situation.
Salary packaging vehicles.
Yeah, that's right. Leasing, salary packaging, motor vehicles. And what happened was that stock effectively halved during that announcement. The coalition announced that they were adamant they weren't going to change the fringe benefits tax rules. You were betting on the election. So selectively you can find good businesses that come back for a particular reason. Then you do a risk-adjusted analysis of what you think they're worth. And so you can make quite good money that way. But I think in general terms it's hard to find value.
So companies you don't like? Well, I'm sure there's a few of them. Maybe run us through a couple of the key ones.
Well, I'll just give you an example. Let's take Telstra. Everyone comes on the show, I love Telstra, I love Telstra, I love Telstra. But let's look at this. 10 years ago, Telstra earned 33 cents a share. This year, they'll probably earn about 32 or 33 cents a share. So 10 years have passed and their earnings per share has done nothing. Their earnings per share, in fact, has been about 30 cents a share, on average, give or take 10% for a decade. Their dividends have averaged about 29.5 cents a share for 10 years now, right? So all it is has been a bond, right? Interest rates come down, share price goes to $3 to $5, everyone falls in love with it. But I don't think that's a great way of investing money. What you and I are trying to do, Marty, is find companies whose earnings are growing sustainably over a 10-year period, not going sideways over 10 years. So I basically just want to boot out every stock that I just don't think have great quality business prospects, or have
Telstra would make your list?
No, I think there's much better quality second-line telecommunications companies. So TPG would be an example. M2 Telecommunication we like very much, but their most recent acquisition saw their debt on their balance sheet blow out, so that made us a little cautious. I think there's a few smaller ones, for example, Big Air Communication, Amcom, iiNet. There's a handful of the second-liners that I would prefer over the majors.
Resources. Do you like anything in that sector?
I think we're struggling, but I think I will make one observation, and that is that the iron ore price at around about $129 has been a lot stronger and firmer than many, including us, anticipated 12 months ago. And what's happening is
it's really a bet on China at the end of the day.
It's a bit of a bet on China at the end of the day. That's right. And that's another story with their shadow banking sector problems. But at the end of the day, if this commodity of iron ore stays high, there will be selectively a few sort of interesting plays, and again, not necessarily in the majors.
So earnings season's coming up. What are your thoughts on what's going to happen there?
Well, I think I tend to agree with Simon. I think there's some industries with very, very good tailwinds. So, for example, I think the healthcare sector, as Simon mentioned, has got a very good tailwind. I think selectively some of the telecom companies have got a very, very good tailwind. I think some of the internet stocks. So you've got to be very selective. You can't just go to What If or Webjet. But I think selectively again, there's some very good tailwinds there. So I would say find those stocks that have good tailwinds, but again, you've got to always be very, very strict about the price you pay.
So under your model then, if the earnings season does, say, surprise on the upside, will that mean that you'll go back to the drawing board and actually revalue a lot of the companies?
Yeah, so you've got to, the first thing you've got to do is you've got to ascertain, are those upside surprises permanent and sustainable, or are they temporary? So you know, I remember when I was up in Asia working, and I got very excited because it was a hot summer, and everyone said, well, buy soft drink companies, it's a hot summer. But you ask yourself, is this permanent change and a sustainable change, or is it just temporary? So, for example, the retailers, some of them are obviously going to have had a very, very good Christmas. But you've got to ask yourself, is that going to change the valuation of that company on a permanent basis or just a temporary basis? And what you're trying to do is dig down and say, yes, this is actually sustainable, this change. This really is setting this company on a new trajectory. And if it is, then it'll quickly come through to the valuation. Be nimble on your feet and then look to buy.
David Buckland, thanks for your time.
Thanks, Marty.
After the break, consumer confidence is on the rise. Our next guest will shed some light on what's driving it.